Stop. Before you scroll, before you assume this is just another metals video, I need you to lock in on one number. Silver is trading around 87.34, and I want you to hear what that number is actually saying, because the most important thing about it is not the headline. It's the confession. This is not an accident. This is not a meme. This is not retail mania. This is what happens when a multi-decade debt machine reaches the point where it has to choose between protecting the currency or protecting the system built on that currency. Here's the authority check you can verify in public reporting. Global debt has been discussed in the neighborhood of the $337 trillion range, and U.S. gross federal debt has been discussed in the high $30 trillion range. That is not background noise. That is the operating system. And once debt becomes the operating system, precious metals don't rally. They reprice the truth. Now I'm going to challenge you with a simple thought experiment, and I want you to actually picture it. Imagine you are the manager of a nation-state that must roll over trillions in debt every year. If interest costs rise for too long, you face austerity, recession, unemployment, and political revolt. If you cut rates too soon, you face inflation, currency pressure, and public anger as living costs rise. So you do what every manager in history does when trapped. You buy time. You talk smoother. You intervene harder. You change definitions. And while you do that, the market looks for the exit ramp. Silver is an exit ramp. And I'm going to do something most videos won't do. I'm not going to guess a random target. I'm going to give you a mechanism, a repeatable, chronological, multi-step pattern that shows up every time a currency system starts losing integrity. If you understand that pattern, you'll know what to watch into the next session, what signals matter, and why the next move is not about news. It's about structural pressure. I'm going to keep this practical. You're going to leave with a checklist you can use tomorrow, a single test you can run to tell the difference between paper noise and physical stress, and 3 tripwire moments you can watch for right before the system changes the rules. And I'm going to tell you the uncomfortable part up front. If we are in stage 3 of this pattern, the outcome is not a matter of opinion. It becomes mathematically inevitable. The only question left is how fast the reset arrives, and whether you're positioned like a spectator or like a survivor. So stay with me. In a minute, I'm going to give you the simplest test you can run tomorrow to know whether this move in silver is a temporary spike or the beginning of a regime change. And later, I'm going to show you the moment that looks calming on the surface, but is actually the warning siren. I'm not here to hype you. I'm not here to scare you. I'm here to show you how the machine works, because when you can see the machine, you stop reacting emotionally to every candle. You start reading the pressure, and silver at 87.34 is pressure. Here is the pattern. 4 stages. It's the same in ancient empires, in modern democracies, in hyperinflations, and in managed inflations. The names change. The math does not. Stage 1 is the setup. A society has a currency people broadly trust. Not because it's perfect, but because the institution behind it still has discipline. Debts exist, but they're containable. Savings culture exists. The system is tight enough that people build long-term plans. This is where the public learns. Money works. And once they believe that, they build entire lives on it. Stage 2 is expansion. Promises start growing faster than production. Wars, social programs, bailouts, corporate leverage, speculation, different costumes, same move. The system discovers it can finance today by borrowing from tomorrow. Borrowing becomes normal. Temporary measures become permanent. Growth looks stronger. Asset prices inflate. Pain is delayed. This stage feels good, which is why it's dangerous. Stage 3 is crisis and loss of control. Compromises collide with reality. Inflation appears, then is denied, then is redefined. Or deflation appears, then is fought with bigger interventions. The signature of Stage 3 is policy contradiction. Stability is claimed while instability is engineered. Trust fractures. People stop holding money because they love it and start holding it because they have to. And then hard assets begin behaving differently, not as investments, but as exits. Stage 4 is the reset. Sometimes it's explicit. A new currency, a devaluation, capital controls, forced conversions. Sometimes it's stealth. Years of purchasing power decay, restructurings, crises that socialize losses. But in every version, Stage 4 marks down old claims and marks up real assets. The public learns the lesson. Paper is permissioned. Now you see why this matters. Silver at 87.34 is not just a price. It's a Stage 3 signal trying to become a Stage 4 event. The market is testing how much pressure the system can handle before it changes the rules. To prove this isn't theory, we'll run the pattern through 3 historical laboratory tests. 3 different eras, same stages, same outcome. First, go back to Rome and watch the slow death of the denarius. In the beginning, Rome has a credible coinage system, predictable commerce, and trust reinforced by discipline. Check. Then costs rise, loyalty must be bought, and the easiest lever becomes the coin itself. Debasement begins quietly. The stamp stays the same while the substance changes. Verified. Over time, the debasement accelerates, confidence fractures, prices rise, and the state reaches for coercion, including price controls, to force reality to behave. Markets go underground when money loses integrity. Undeniable. And eventually the system shifts toward reforms and harder anchors, not because leaders suddenly become virtuous, but because the old rules can't survive once trust is gone. Check. Next, jump to Weimar Germany and watch the same stages run at terrifying speed. It begins with a culture built on stability and the expectation that savings hold meaning. Check. War breaks constraints, debt and money creation expand, and the pitch is always the same. It's temporary, the future will pay. Verified. Then the spiral becomes visible. More claims, less output, accelerating prices, and a public that stops saving and starts fleeing because money no longer coordinates society. Undeniable. Stabilization arrives only when the regime changes the unit and rewrites promises, wiping savers, relieving debtors, and rewarding holders of real assets. Check. Then look at the United States from Bretton Woods through the 1970s and into the 1980 silver drama. It starts with dollar credibility anchored by convertibility and real surplus. Check. Promises expand faster than discipline, dollars accumulate abroad, and pressure builds on the anchor. Verified. The anchor breaks, inflation shocks hit, controls appear, and metals reprice. Silver spikes, then the plumbing fights back with rule changes and margin pressure, and the thermometer gets blamed for the fever. Undeniable. Credibility is rebuilt through pain and a tighter regime. The reset is never free, it's assigned. Check. 3 laboratories, same stages, same logic. Now we apply it to today, to silver at 87.34, and to what you should watch into the next session. Stage 1 in the modern era was the belief that central banks could engineer stability. After 2008, the world learned that liquidity could solve crises. After 2020, the world learned that trillions could be created, rates could be pinned, and the bill would be invisible. Intervention became normal. Asset prices became policy. The public learned they will always step in. That was the setup. Check. Stage 2 has been the normalization of overextension, sovereign deficits, corporate leverage, households trained to depend on asset inflation, a world where refinancing at low rates becomes life support. And when debt becomes that large, the system cannot tolerate sustained high real rates without breaking something, so the machine keeps needing accommodation. That's stage 2. Verified. Now stage 3, the part that explains silver. Stage 3 is when the system must choose, and it cannot admit it's choosing. It must claim it can defend purchasing power and protect the debt structure at the same time, but those goals conflict. Tighten enough to defend the currency and you crack the debt machine. Loosen enough to protect the debt machine and you bleed purchasing power. That contradiction is stage 3. Undeniable. And stage 3 always produces the same market behaviors: volatility, narrative warfare, flight to hard assets, and eventually rule changes. Now here's the reveal. Silver is not just a metal. It's a stress test. Silver is a hybrid. It acts money-like when trust fractures, and it is industrial when the economy still needs it. That combination creates asymmetric pressure. Monetary demand collides with physical constraints. And because the silver market is thinner than global capital flows, it doesn't take a huge shift in behavior to create outsized moves. Now let's talk mechanics, but in a way you can actually use. Silver trades in layers: spot, futures, options, ETFs, unallocated accounts, physical coins and bars with premiums. In calm times, arbitrage keeps those layers connected. In stage 3, the connections strain. In calm times, most people trade exposure. In stress times, the marginal buyer asks, "Can I actually get it?" That question changes everything. When enough buyers ask it at once, paper price becomes an invitation to demand delivery. And then exchanges and brokers tighten the plumbing, raising margins, restricting leverage, changing collateral rules. Not moral, survival. So here's the simplest way to understand silver at 87.34. Either price is rising to ration real demand, or price is being driven by leveraged paper flows that can unwind violently. In stage 3, both can happen together. That's why the next session matters. It reveals which force is dominant. Now the simplest test you can run tomorrow, treat it like a rule. Ask this: when silver pulls back, do physical signals loosen or tighten? If price drops and physical premiums collapse, delivery stress eases, and demand dries up, the move was mostly paper momentum. If price drops and physical premiums stay elevated, delivery stress persists, and buyers treat dips as opportunities, then the market is not correcting. It is consolidating a new reality. That one test cuts through the noise. Remember it. Before we go to the 5 watches, I want to slow down on one point because this is where most people misread the tape and lose both money and confidence. In a normal market, price is discovery. In a stressed market, price is negotiation. And in a system-level stress market, price is a referendum. When you see silver at 87.34, you're not just seeing buyers and sellers arguing over a commodity. You're seeing 3 different groups with 3 different motivations colliding in one place. Group 1 is the hedgers and industrial users. They don't care about your chart. They care about securing supply at a predictable cost, so they can keep building products. When their risk managers get nervous, they don't buy because it's exciting. They buy because shortage risk is worse than price risk. That's a subtle but massive difference. In a shortage scare, expensive becomes cheaper than unavailable. Group 2 is the macro capital that moves like a tide. These are funds and institutions that don't think in ounces, they think in flows. They compare silver against real yields, the dollar, risk appetite, and policy expectations. They can push price quickly because their size is large, and their decisions can be synchronized by the same models. When they shift, it looks like a cliff or a rocket. Group 3 is the public crowd. Retail, media-driven participants, latecomers, people who hear silver is exploding and want to get involved. This group brings emotion, speed, and volatility because they tend to buy when it feels urgent and sell when it feels hopeless. The crowd doesn't create the structural pressure, but the crowd can amplify the move once the pressure is already there. Now here's the trap. If you watch only the price, you can't tell which group is in control. But if you watch the right secondary signals, you can. That's why the physical signal test matters, and I'm going to deepen it so you can apply it even if you don't have fancy data. You're looking for friction. Friction is the gap between paper price and physical reality. When markets are calm, paper price and physical availability stay fairly aligned. Premiums are modest. Delivery is routine. You can buy, you can sell, you can source metal, and the whole thing feels boring. When stage 3 pressure rises, the friction shows up in small ways first. Dealers start quoting longer wait times. Premiums stop falling even when spot pulls back. The spread between different forms of silver widens. People start asking more questions about allocated and unallocated. That's not because they suddenly became experts. It's because fear makes people care about the difference between a claim and a thing. And if that friction grows, the market starts behaving like this. Spot can pull back, but physical stays tight. That's the moment you should take seriously because it means price is no longer purely a paper argument. It's a supply argument. Now I'm going to give you a simple way to visualize this because retention lives in pictures. Think of the paper market like a highway and the physical market like a bridge. In calm times, traffic flows smoothly. In stress times, everybody tries to exit the highway and cross the bridge at the same time. The bridge doesn't expand just because more cars show up. So what happens? The system either raises the toll, price, to reduce demand, or it rations access with rules. Sometimes it does both. That's why you see parabolic moves followed by sudden dumps. That's not random. That's the highway and the bridge fighting over throughput. Now let's talk about the rule change piece, because this is the part that makes people feel like markets are rigged, and that feeling destroys retention because it turns into helplessness. So I want to make it precise, so you can anticipate it instead of fearing it. Rule changes are not usually announced as, "we are controlling the market." They are announced as risk management. Margins get raised to protect participants. Position limits get tightened to ensure orderly markets. Collateral rules change to maintain stability. Brokers restrict leverage to manage volatility. That language is always the same because the function is always the same. Slow the stampede. In stage 1, these tools sit on the shelf. In stage 3, they come off the shelf. So your job is to treat rule change risk as part of the environment. Don't take it personally. Don't build a plan that assumes the environment won't change. Now I'm going to give you a retention anchor you can repeat to yourself every time you feel emotional. When you're trading a stage 3 market, you are not trading just supply and demand. You are trading supply, demand, and policy reaction. That third variable is what surprises people. Because the system doesn't react when price moves a little. It reacts when price movement becomes socially contagious. It reacts when volatility threatens collateral. It reacts when headlines start translating into behavior. That's why silver is different at 87.34 than silver at 27.34. Not just the number, the social meaning. Now let's go tactical, because I promised practical. If you want to judge the next session without being glued to every tick, you can break it into 3 time windows. The open is where emotion shows up. Gaps, spikes, quick squeezes, fast sell-offs. This is where leveraged positioning gets tested. The middle is where structure shows up. Does the market hold levels? Do dips get bought? Do rallies get faded? This is where you learn whether the move is being accepted or rejected. The close is where intent shows up. Is the market willing to hold risk into the next session, or does it dump into the close? In stage 3, closes matter because they show whether fear is rising or calming. You don't need a perfect chart. You need that sequence. Now, I want you to hear this. Stage 3 is not a straight line. It's a tug of war between reality and the institutions trying to postpone it. That tug of war produces the most confusing price action of your life if you don't have a map. So here's the map, simplified into 3 sentences. If the market is accepting higher prices, you'll see pullbacks that get bought and levels that hold. If the market is rejecting higher prices, you'll see rallies that get smothered and levels that break cleanly. If the system is forcing leverage out, you'll see sudden air pockets that feel disconnected from logic. Now, one more engagement loop before we go to the 5 watches. I want you to test yourself. If silver drops 5% tomorrow, what will you believe? Will you believe it's over? Or will you ask the only question that matters? Did physical loosen or did it stay tight? Because if you can do that, you've just separated yourself from the crowd. And that's the whole game in stage 3, separation. One more thing. Don't underestimate how much stage 3 is about confidence, not just economics. A currency system is a shared agreement. It works because most people believe most other people will accept it tomorrow. When that belief is strong, the system can survive big shocks. When that belief weakens, small shocks become big because the reaction changes. That's why you'll see moments where nothing new happened, but the market moves anyway. The move isn't about the news, it's about the belief. And silver is where belief becomes visible. Now I'm going to add another layer, because some of you are thinking, okay, I get the macro, but what do I actually do with this information without turning it into a gamble? You treat this like a weather system, not like a lottery ticket. In a hurricane, you don't stand outside arguing about whether it will rain. You secure your house, you check supplies, you plan routes, and you reduce exposure to fragile things. Stage 3 is the hurricane phase of monetary credibility. So the practical mindset is simple. Reduce fragility. Fragility looks like leverage that can be margin called. Fragility looks like time horizons that don't match your instruments. Fragility looks like being forced to sell because you need liquidity at the worst time. So if you want one actionable takeaway that isn't hype, it's this. Design your exposure so you can survive volatility without making a forced decision. And I know you want specifics, so here are 3 simple principles you can apply immediately. First principle, separate trading from insurance in your mind. If you're trading, you're accepting that you can be wrong and you want to be wrong small. That means you define risk, you respect stops, and you don't argue with the tape. If you're holding as insurance, you accept volatility and you focus on the structural signals, not the daily noise. Insurance is not supposed to feel exciting. It's supposed to be there when the system does what systems do. Second principle, respect the system's ability to change the rules. In stage 3, it's not just that price moves, it's that the rules around price can change. Margin can change, liquidity can vanish, counterparty risk can matter more. That's why the difference between a claim and a thing becomes psychologically important. Third principle, keep a decision firewall. A decision firewall means you decide your plan when you're calm, not when you're scared. Because the market's job in stage 3 is to make you feel something so strong that you abandon the plan. Now here's a quick way to apply that firewall into the next session. Before the session opens, decide what would make you change your mind. Not what would make you feel something. What would make you change your mind? For example, if physical premiums collapse and availability loosens for several days, that's information. If real yields rise and stay high while metals weaken across the board, that's information. If volatility cools and the market returns to boring behavior, that's information. But a single violent candle is not information by itself in stage 3. It might be leverage flushing. It might be a headline. It might be a rule change. The candle is the symptom. Your job is to identify the cause. If you do that, you stop being reactive. And when you stop being reactive, you win the only battle that matters, the battle for your own decision-making. Now we can go into the next session with clarity instead of adrenaline. Now, what specifically should you watch into the next session? 5 watches, not predictions, watches. Watch 1. Real yields and the bond market's message. Metals compete with real returns. If real yields rise and stay high, it creates gravity on silver. If real yields wobble or the market price is easing because something is breaking, metals get oxygen. Don't obsess over one headline number. Watch whether bonds tighten with conviction or flash stress. Check. Watch 2. The dollar versus silver behavior. In normal times, a stronger dollar pressures metals. In stage 3, the correlation can break because the metal is repricing credibility. If the dollar firms and silver refuses to collapse, that's a loud signal the bid is structural. Verified. Watch 3. liquidity and policy tone. Stage 3 is hypersensitive to hints of support. A softer tone, new facilities, or a shift toward financial stability language is interpreted as permission for debasement. A hard tone without follow-through is posturing. Watch actions, not speeches. Watch what gets rescued. Watch what is allowed to fail. Undeniable. Watch 4. Paper to physical pressure points. Delivery months, inventory headlines, physical premiums. Even if you don't track granular data, watch the symptom. Are people talking more about availability than about price? When that shift happens, you're moving deeper into stage 3. Check. Watch 5. Rule change risk. The moment a market becomes socially important, the probability of rule changes rises. Higher margins, position limits, broker restrictions. These aren't conspiracies, they protect plumbing, but they create sudden air pockets in price. Any unusual notices or margin chatter matters because it signals the system is preparing to manage volatility rather than let price discover freely. Verified. Now, the question everyone asks, up or down? The honest answer is both are possible fast, and both can still fit the same stage 3 reality. So here are 2 scenario maps. Scenario 1, continuation with structure. Silver opens strong, pulls back, and is bought. The market accepts higher prices. Volatility compresses slightly. Physical premiums stay stubborn. That's repricing becoming normal. A new floor forming. Scenario 2, liquidation event. Silver spikes, then gets hit with a sudden dump. Fast candles, thin liquidity, maybe margin chatter. The move looks irrational because it's mechanical. Weak hands are forced out. If physical premiums stay tight during the dump, the liquidation is a reset, not a reversal. If premiums collapse and buyers disappear, the rally was dominated by paper leverage and the system cooled it. Here's the key. Stage 3 markets often do both. Rip, dump, rip again. Because the system is fighting the message. That's why risk management matters more than your opinion. Now let's talk about why silver becomes explosive in this specific era. Silver has a split personality. It can behave like money when confidence cracks. It can behave like an industrial input when production systems keep consuming it. That means when fear rises, investment demand can surge at the exact moment industrial demand doesn't politely disappear. Then supply can't respond instantly because much of silver is produced as a byproduct of mining other metals. You can't flip a switch and mine more silver tomorrow. So when demand surges, the market's immediate tool is price. Price becomes the rationing mechanism. That's why stage 3 repricing is violent. Paper is trying to price physical reality. Here's the next session translation. If you see spikes that don't bring a wave of sellers even at high prices, it suggests the available float is tighter than people assume. If every spike is instantly sold and physical premiums soften, paper is driving and physical isn't stressed. Now add reflexivity. When silver becomes a public story, coverage drives curiosity. Curiosity drives flows into silver products. Those flows often land first in paper vehicles, which pushes price, which then wakes up the physical market, which widens premiums, which creates new headlines. It becomes a loop, and loops overshoot. So here's your hourly question for the next session. Is the loop strengthening or weakening? Strengthening looks like higher lows, stubborn premiums, dips bought without panic. Weakening looks like heavy selling on rallies, premiums compressing, and the conversation shifting from protection to escape. If you can answer that calmly while everyone else reacts emotionally, you're ahead. Now, urgency without fear. Stage 3 is where people lose not because their thesis is wrong, but because they underestimate the system's tactics. In stage 3, rules can change faster than your position can adapt. That's why leverage is dangerous. You can be right and still get liquidated. Liquidation doesn't care. So here's the practical rule. Match your position to your time horizon. If you're here for a multi-month or multi-year repricing, don't structure like a day trader. If you're here to trade, don't pretend correlations are stable. Stage 3 punishes sloppy alignment. Now, the crowd psychology flip, the trap that ruins people. In stage 1 and stage 2, silver is boring. Then stage 3 hits, and silver becomes a story. The story turns into identity. The moment it becomes identity, volatility amplifies. The crowd piles in late. The system tightens plumbing. The crowd gets punished. Not random. That's how leverage gets cleansed. So don't let narrative intensity decide your size. Let structure decide it. Let plan decide it. Now we stamp the present. Setup. Intervention normalized. Check. Expansion. Promises outrunning production. Verified. Crisis and loss of control. Contradictions, volatility, and hard assets acting like exits. Silver at 87.34 is a stage 3 symptom. Undeniable. So what is stage 4 for our era? Stage 4 can be loud or quiet. It can be a sudden event or a long grind. It can be a stealth default through inflation, a restructuring cycle, or new forms of control framed as stability. but the function is the same. Promises get rewritten because they can't all be honored in real purchasing power terms. And this is where silver becomes more than a trade. In stage 4, people discover that cash is not neutral. Cash is a policy object. Cash is what can be frozen, taxed, converted, or diluted. Hard assets are not perfect, but they are harder to rewrite with a press release. Now the 3 tripwire moments. Memorize these. Tripwire 1 is the calm narrative. When the message shifts from, we have a problem to we have a plan while the numbers worsen, that's the bridge. The plan buys time. Time allows debasement to do its work quietly. Tripwire 2 is moralization. Speculators, hoarders, manipulators. That language often appears right before rule changes, because control needs a villain. Tripwire 3 is safety. New safety rules, higher margins, tighter collateral, reporting, limits framed as protection, often appear when volatility is being managed, not discovered. Pattern. So don't just watch price. Watch language. Smooth words with rough reality is the red flag. Now your next session checklist, clean and simple. Does silver hold key levels even if the dollar firms? If yes, structural bid. Do real yields rise with conviction or wobble? Wobble gives metals oxygen. Do physical signals stay tight on dips? If yes, not just paper. Do we see rule change chatter or margin actions? If yes, expect spikes. Does the narrative become everything is fine while volatility stays high? That calm narrative often precedes the next leg. Now the 3 mental traps that destroy clarity. Trap 1. Exceptionalism cancels the pattern. It doesn't. It delays it. Trap 2. Technology erases the bill. It helps productivity, but it doesn't cancel promises already made. Trap 3. Smarter central banks override incentives. Incentives win. Someone always pays. So the conclusion is clarity. Silver at 87.34 is a warning light, not a prophecy. It tells you the system is under credibility pressure. It tells you more participants are treating metal as insurance. It tells you the next session won't be normal, because stage 3 destroys stable assumptions. Your job is not to predict the next candle, it's to understand the machine. Because once you understand the machine, volatility becomes information. Protect your time horizon, protect your liquidity, avoid leverage that can be wiped by a rule change. If you're accumulating for preservation, focus on consistency and on the physical signal test, not daily drama. If you're trading, trade smaller and accept that the market can do irrational things because the system is not trying to be fair. It's trying to survive. Now the warning and the call to action. The warning, the 4-stage pattern is absolute. Setup, expansion, crisis, reset. People can debate narratives, but they cannot debate arithmetic. If debt is enormous and incentives favor postponing pain, purchasing power becomes the pressure valve. Silver is reacting to that pressure. And when the pressure builds, the release is never polite. So if you want to be ahead of the next stage, you need to understand how the machine was built, how debt became policy, how policy became price, and how the next interventions will try to steer behavior when the market stops cooperating. Subscribe, because in the next video we're going to map the exact points where the system will likely attempt to regain control, the mechanisms, the rule changes, the narratives, the stability tools, and how to survive the coming reset without being forced into bad decisions at the worst moment. And one more thing before you go. If you want a follow-up that's even more tactical, comment the word checklist, and I'll build a session guide you can use every day. What to watch, what to ignore, and how to tell when the pattern is accelerating. Silver at 87.34 is not the end of the story. It's the chapter title. Into the next session, don't watch the noise. Watch the dials. The dials tell you what stage we're in, and the stage tells you what comes next.